Okay, welcome everyone to this fifth era webinar on a very hot topic question. Is AI a bubble? This is something that we're seeing a lot of headlines about. We're getting asked a lot of questions ourselves from investors who are interested in our perspective on this question. So we'll spend the next, I'd say 45 minutes discussing this, hopefully with room for Q&A at the end. And as I mentioned, there is functionality to ask your questions in the chat. So before we get started, just a disclaimer. Fifth Era is a registered investment advisor. So we will not be making any solicitations during this webinar. These webinars are purely educational. So we don't suggest taking investment decisions on the basis of anything you hear today. What we're going to cover, so I'll briefly give an overview of Fifth Era, who we are, for any of those who aren't familiar. And then we'll dive into the bulk of the discussion, which is on the question, is AI a bubble? So we're going to cover where we are in the tech cycle right now, look at some historical precedents in terms of prior technology cycles and what we can learn from those, then talk about why this stage matters for investors and for those of you joining, and then how we as Fifth Era are positioned for this moment, and hopefully with time for Q&A. We will not cover any detail on our investment strategy or funds or terms of any of our vehicles in this conversation. So who we are, Fifth Era is a specialized asset manager. We provide access to exponential technologies that we believe are transforming our world. And our name is Fifth Era because we believe we're entering a period of unprecedented innovation. Every industry business will be transformed. We're already seeing that to be the case. And we focus on investing in the technology that underpins this innovation. And we are now SEC registered in the US and FCA appointed in the UK. At a glance, we've been operating for just over a decade. We manage 7 funds across our technology verticals. The core to our strategy is fund of funds. So there are over 50 VCs that we partner with and have backed across our vehicles. And as a result, we have exposure to over 1,500 portfolio companies, of which over 80 unicorns. So it's been a very successful strategy for us to date. And we cover, obviously, blockchain, fintech, crypto, digital asset spaces, and now, as of the past year, have expanded into AI as well, which is the focus of this webinar. These are some of the VCs that we're partnered with. Most of these are blockchain VCs. Our AI VCs will soon be added to this page as we formalize commitments with them. So there'll be new names coming in. We have longstanding relationships with many of the names here. And these are the 80 plus unicorns I mentioned. Some of these names will be very familiar to some of you already, and some may be becoming more familiar because we're in a moment where many of these companies are announcing their intentions to go public, which has been very exciting. So our investor value proposition is quite straightforward. A single investment with us provides access to global, diversified exposure to these early stage technology areas, whether it's blockchain or AI in this case, on an institutional platform. So we enter where valuations are low. That's why we like the early stage, where we can often expect the greatest returns. And we diversify across the stack with the managers we partner with. And we are an institutional platform that's been doing this for just over a decade. This is our team, our managing directors, Allison and Matthew. We have partners aligned to our different verticals, and I lead our AI strategy. And then we've been expanding the team as well. In New York, we now have Winnie Pritchett, who is our head of capital formation. And we have an open role, similar open role here in San Francisco. If any of you have thoughts on that, you can contact us after this webinar. We always welcome great new talent. Okay, let's dive into the core of the conversation today, which is AI a bubble? So just to orient us with the same language here, what is a technology bubble? We see tech bubbles are usually characterized by 4 things. The first is that capital is flooding into the space very quickly. It's a new technology area. There's a lot of enthusiasm. And so that capital is coming in often faster than companies can actually get adoption for their platform or service or see revenues maturing. So that's number one. The second thing that happens then as a result is often the company valuations can get more inflated. So the companies start being priced on the potential that they hold in the future rather than their current cash flows or proven demand. The other thing we see because of the capital flooding into this space is that weaker projects can get funded alongside strong ones. So the capital and investment ecosystem is very abundant, the bar for funding lowers, and that can mean that stronger and weaker ideas alike will receive backing. And what typically happens after that is there will be a correction. So expectations reset at some point, those valuations come back down. The weaker companies that got backing often fail. Those are kind of the experimental early use cases in any given technology area. But then what remains, and this is kind of the critical part, what remains is the durable infrastructure that's been built, category leaders who have gotten a start early on, and signal remains. So we call it kind of separating the signal from the noise. There's a lot of noise, and after this correction, what remains is the true signal. So making it specific to AI, why does AI feel bubble-like right now? Well, there's four kind of core elements at play in the current AI moment that we see. So let's talk through them. The first is late stage valuation. So we see a lot of multi-billion-dollar private valuation. So people often cite OpenAI has almost a $500 billion valuation right now. Anthropic's close to 200 billion, I think now. These are private companies, but they have enormous valuations at their later stage. And that's often before the path to profitability is really clear. We're also seeing very large funding rounds. So some investors are hearing about, billion-dollar seed rounds, right? Especially in the world of AI. So those are being priced more on an expectation of what could happen in the long term or how that company could win in the market in the long term, rather than actually any current revenue or profitability that they have. And then the gap between early and late stage valuations widens. And this is an important point, especially for our network ecosystem investors, because early stage investing tends to remain more grounded. It's not a given, but the risk reward is very different depending on where you enter the market. In the early stage in AI right now, you can see pre-money valuations between, say, 10 and 30 million. So very different from the multi-billion-dollar figures we were mentioning in the later stage. Okay, point two, massive investment. So hundreds of billions being committed to especially the infrastructure or picks and shovels layer of AI. This is hardware like data centers, chips, other infrastructure. And spending is happening years ahead of revenue realization. A lot of this is just very normal. Early spending in a tech cycle lays the groundwork for future businesses that will arise. And that infrastructure has to exist before those products can scale. So it's a little bit normal to see this, but it can make investors nervous because of those longer payback periods. So, meaning if it's going to take years for these investments to pay off or to start seeing the returns, then, there's this time frame in which they could be exposed to sentiment shifting or confidence taking a hit or whatever may happen. So that's the investment side. Then unprofitable companies. So this just meaning that some of the big AI companies we see right now are very much in cash burning mode. Again, it's sort of normal given the moment we're in. Why? Because they're setting the groundwork. They are training all these massive models. They're running inference on the models. They're hiring all their talent. They're building the infrastructure, right? So that cash consumptive nature is actually reflecting how expensive it is to build these systems at the frontier. But it can look, a lot, but to a savvy investor, it's not, it can look, I don't want to say the word alarming, but, it can set off a bell. Okay. Revenue growth does exist, but the long-term durability and defensibility of that revenue remains to be proven. So, in other words, it's just basically saying they are generating revenue, but the quality of the revenue is still being tested. So how will the margins shake out? Will they really have user retention? How defensible is what they've built against, for example, OpenAI moving in and taking in that space? We get that question a lot. What will the LLM incumbents do? Where are they going to make moves into the app layer? So that's normal, very normal this early, but it does increase uncertainty. And then profitability, and that's why they, if it says unprofitable companies, they're deferring that in favor of speed and scale. Right now, it's a big early moment. And so these builders are just thinking, grow, capture the market, be the first to get to the users, because that will later translate into the sustainable economics. So right now it's all about speed, scale, capture the market, less about profitability. And then finally, enthusiasm and .com 2.0 story. So we do see, 50% of fund managers now describe technology stocks in general, but also AI as bubble-like. So there are concerns about pricing that I mentioned, and this risk as we move into this new moment. A lot of media comparisons, and then you have these behavioral dynamics of fear of missing out. So where people are both either very enthusiastic or very skeptical and wary. It's kind of this dual psychological pressure you often see in these tech bubbles. So all of this to say, none of these signals mean AI isn't real or that there isn't real value being generated here. It just means we're very early on, it's noisy, and it is capital intensive because we're building for the future. And let's talk about the time frame. So for those of you who like baseball, you'll probably like this comparison. We say we are still in the very early innings, like the first inning of a 9-inning baseball game when it comes to AI. So inning 1, where we are now in the cycle, I'd actually say 2022 till now, not 2023. But we're in that build mode that I mentioned. We're building out the infrastructure, so the compute, the models themselves, the data centers, chips, all these things. You have the LLM players exploding onto the scene with their models. You have early enterprise pilots. So almost every industry, corporate, is looking at how to embed AI into the organization across their functions. They are being met with quite a bit more inertia than that's a tale as old as time. It takes a while to really shift processes and capability and people and mindset. And then there's been rapid consumer adoption. And that's, there's almost 1 billion users of AI right now globally, which has been enormous growth if you compare it to, for example, the internet, but it's uneven. And you do get some, when you have adoption outpacing things like safety or regulation or security, you do get shadow AI usage. You see these kind of less than ideal uses of a new technology. It was the same with the internet. It was like dark web and spam and pop-ups and things like this. So we're a little bit in that moment. I would say we are starting to shift into inning 2, or we're somewhere between 1 and 2. So this is where you move from kind of pilots and building the foundations, experimentation, into seeing real performance. So we will expect pretty much full enterprise adoption, that AI gets embedded into all of their workflows. We'll see more and more verticalization, which is industries embedding solutions specific for their use cases rather than trying to use the generalist tools for their work. AI, operational AI, meaning AI and deployment. And that's when you really start to see the cost reduction, the efficiency and productivity gains, and the ROI. And then consumer correction. So from that shadow AI more to knowing how to use the technology, how to use it safely, responsibly, ethically, governed better experiences, all those sorts of things. Mm-hmm. So then inning 3, in our view, will be a big shift driven really by agentic. So this is where the software AI becomes not just a tool you use, but a system that can act on your behalf. That's really the promise of agentic. So moving from tool to doer, we'll see that will cause, will be a real paradigm shift away from software as a service, which has been the current paradigm and is a massive industry in its own right, to using agents for those services. And we'll see a lot more human AI collaboration for decisions, whether in work or just day-to-day context, and new business models will arise. So we'll see more of the top line growth as companies figure out how to leverage AI to really drive entirely new streams of revenue for themselves. And then inning 4 plus, because it kind of we're calling it beyond, it's, to be honest, even the smartest experts have some humility in this space, because it's hard to fathom what we can't fathom. We know new industries will arise that we can't name yet. Similar to the dawn of the internet, we couldn't have fathomed social media. We couldn't have fathomed e-commerce, right? These are massive industries that arose years into that evolution, and we're not there yet. So those will arise. We expect a real reconfiguration of labor, of expertise, of education, of many systems will be touched by this technology and the way we organize around them. And then you'll start to see also second and third order economic effects. So that just means, the first order effects are the immediate impact of the technology, automating tasks, speeding up work, et cetera. But second order and third order are kind of the larger systemic shifts. And also here, durable value creation will in earnest, we'll reach that state. Okay, so this is where we are in terms of time. I want to touch on also where we are in terms of size, scale, how large this really is. It is a global, broad-based transformation. The market, if we look at market, geography, industry, in terms of the market, the global AI market is still expected to reach 1.8 trillion by 2030. Last year, well, I guess not last year anymore, we're in 2026, but in 2024, it was 280 billion. So that's representing a 36% year-on-year CAGR within that time frame. We are now, estimates differ, but between 1.2 to 1.8 billion global users of AI. That's up from just 300 million in 2024 again. So this page on our presentation is constantly updating because the space is shifting so rapidly. In terms of geography, we're at about 50% global AI adoption rate, and new countries every day are launching national AI strategies. They're ring fencing funding and investment for this, not just in the technology, but the job transition, upskilling people with new capabilities, improving AI literacy, governing the technology, protecting critical infrastructure from cyber attack, all these sorts of things. This is a huge focus right now. And actually, most OECD and G20 nations now have strategies in place for AI, according to the Oxford Insights Readiness Ranking. So, and then industry-wise, I mentioned we're at 80% of global organizations adopting as of 2024, which is a large increase. And it's moving from experimental to more broad-based across functions. So we're early on. It's already massive in terms of its width, depth, scale, and we're just at the start. But don't just take it from us. This is not just our interpretation. Experts believe that the growth we're seeing here is sustainable. So yes, there are the headlines about the noise and the concerns, but others such as Goldman, JP Morgan, McKinsey, Wedbush, et cetera, have all posted notes about their view on why this is in fact a sustainable space. And some of the rationale they give. So number one, AI CapEx is still small relative to the overall economy. So the investment currently is just under 1% of US GDP. That's according to Goldman Sachs. If you compare that to past tech buildouts, they peaked closer to 2 to 5% of GDP. So it suggests there's still room. And it means the spend in this space feels very big, but relative to the overall economy, it isn't yet necessarily. Second point, infrastructure spend precedes revenue in every major tech cycle. So this is a point, that there is this heavy upfront investment that's typical in these platform shifts. We saw it in railroads, we saw it with electricity and the internet. There was a large upfront cost required that then monetization followed after. So this phase looks expensive before it looks obvious. There's another way of saying that. Third point, productivity gains could become very meaningful. So hand in hand, when we talk about AI, we hear the terms productivity, efficiency, this promise that it makes everything we do as humans more efficient, effectively. And that productivity, we're not seeing it yet, but it's estimated that it could be in the multi-trillion range over time. It's massive. So, and we do see early impacts of that in software services. We are seeing the initial trickling in. But the point is that even if this technology was only to realize a part of that estimate, it would massively justify investing seriously in this space over the long term. So we're early in that space as well. And it just means the payoff horizon is longer, but could potentially be huge. And then lastly, volatility is to be expected, not a sign of collapse. So what this means is, yeah, corrections are very common. We've seen them time and time again during early technology adoption. What happens is that influx of capital that you see early on reaches a point where it becomes more strategic and selective. And so that actually means that in a cool down, the capital is going to reallocate from those weaker projects to the stronger ones. And so the market's reset, and that's when the durable winners emerge. But most of them actually started building prior to any cool down in many cases. And we're going to look at an example of that in a minute. Okay. As investors, many of you have seen this before, especially with the internet in late 1990s, early 2000s. So there's a very similar arc here. If we just focus on the top of this slide first, this is showing that arc of the internet. So first we had very early foundations being built, the infrastructure, all the internet protocols, early apps. A few companies during that time found real product market fit. The likes of Amazon, Apple, Microsoft were very early to the game. Capital rushed in as a result. You have the valuation expansion we talked about, and then this speculation follows. Eventually that bubble bursts. But what's super important is what didn't disappear. So what remains? The infrastructure stayed after having been built. The technology still continued to advance. The companies that were founded and built on real utility early on survived and thrived and grew. Many of them were even founded during the crash and went on to now be defining companies of the next 2 decades, pretty much. So, and the internet now underpins absolutely everything we do. So, similar to that arc, we believe that AI is following a similar trajectory. So, on the bottom here, 2022, we started from 2022, although if you see here, foundations of AI already built since 1950s. Really, this technology, artificial intelligence, is as old as the internet in many ways. The term was coined in the 50s. It had early iterations in neural networks and in machine learning and big data over the years. It's been evolving, but the foundations have been being built for a long time. But we say 2022 to present just because the launch of ChatGPT onto the scene in late 2022 was a real inflection point for consumer understanding of this technology. In any case, so same thing, foundations being built, the models now, the compute, we have a lot of the data infrastructure. We do see some early product market fit in a handful of applications that exist. And yes, we now have this capital influx, the valuation expansion that we've seen before, and there is this noise and speculation that happens. So, and we believe we're sort of right there before this correction. And the question isn't whether the volatility will happen. It sort of already is. The real question to ask, and especially as investors, is which companies and strategies to invest in those companies are positioned to emerge on the other side of any correction. And we believe we're right there in the middle of it and that it's happening. So all of this to say, the market is definitely, the AI space is definitely transitioning right now from this kind of excited, enthusiastic, indiscriminate capital allocation to a much more selective capital. And that's when strategy starts to really matter when it comes to investing. And the other point, very important for investors, is historically, one of the worst times to invest is actually at peak certainty. So once everyone feels like they know who the winners are, there's certainty on the trajectory, that's not a good time to invest, right? It's already kind of late. So the best, we feel the best risk-adjusted opportunities happen when the enthusiasm cools, capital becomes very selective, and the real businesses who are building sustainably and with longevity keep building. And that's when you have the real winners emerging. So similar arc possibly to the internet. And if we look at the internet in slightly more detail, this is just a chart showing the boom and bust. Again, suggesting volatility, which we've seen before, does not mean failure. This is just what technology cycles often look like in the markets. And many of the valuable companies of the internet era were founded or scaling during this time period, often during the most uncertain times in terms of, general public sentiment. So, Amazon is tracked through here and things like this. So, we're not saying that the volatility is good. We're saying it's not the same thing as failure, and there's historical precedent for it. And to be honest, if you were investors in Amazon or Google or any of those others in the early 2000s time, late 90s timeframe, you would be very pleased with yourself, to say the least. Okay, and last point, also comparing to the internet, is about adoption and about long-term payoff. So while the markets were very volatile in that period in the late 90s, early 2000s, you can see internet adoption was still very low, and it continued steadily. I mean, there's a real increase then over the next few decades. So the real value of the internet was not realized at that peak of excitement during that time frame, in the bubble excitement phase. It was actually realized far after that. The usage just compounded and compounded all over the globe. New applications emerged. So AI is in a similar early phase to this. We're in that enthusiastic period, and we all already, by the way, as I mentioned, at 1 billion users globally after just a few years, whereas it took 20 years for the internet to get to 5 or 6 billion users. So it's kind of on a pace and scale that we've never seen before, although we can draw comparisons to past tech cycles. So that's kind of the tech cycle, the historical precedent. Why does this stage matter for investors? So 4 points we want to make here for all of you listening and curious. The first is that prices and valuations tend to reset before the winners are obvious. So the best opportunities happen often in the uncertain period, so before we have consensus clarity. Because as I said, by the time everyone agrees which companies matter, who are going to be the big winners, the valuations have already moved on. They're like, we're seeing these multi-hundred billions, et cetera. So you have, that value generation opportunity has been missed by that point. Second, when the noise fades, the signal improves. So as I was saying, right now you have this moment where weaker teams and ideas could get funding, same as the stronger ones. Well, those teams will now lose the funding. When capital gets more, when the conditions tighten and the capital gets more selective and more, almost critical, it's the stronger teams who keep building. And that's when the signal improves. So from an investor perspective, can actually be a healthier environment for investment, not a worse one. And our managers and the VCs we work with actually like this phase a lot because it forces discipline and because there's this cool down, this like tourist capital that was flooding in kind of fades away, but it's the real durable solutions that they're now looking at, speaking with, and they're leaning into those teams. Okay. Third, real platforms keep getting built. So the infrastructure investment that we've seen, spiking continues regardless of what the market is doing or saying, whether it's enthusiastic, whether it's skeptical. There's not going to be a reversal in investments in data centers, in the models, in the tooling. Enterprises aren't going to roll back the investment, budgets that they committed to integrating this tooling into all the fight. It's not going to happen. So the platforms are still going to continue to be built. And the fourth one is that the biggest winners are often founded or funded during volatility. So I mentioned Amazon and Google. Amazon was founded, before the dot-com boom and survived. Google was right just before in 1998, if I'm correct. And then Airbnb is a slightly different example, but they scaled during the financial crisis. So just another example. So our view here is that as investors, you should not look away right now. Now is the time to lean in. And if you choose to, you can do that with us. Why? Because our strategy is built for this environment. As I mentioned, over a decade, an institutional platform investing in these frontier technology areas. We've seen these cycles, and we have designed our strategy for them. We believe it's very fit for purpose for the moment we're in for a few reasons. One, the early stage focus. We invest where the valuations are still lower, still defensible. And so the risk reward, we're avoiding some of that late stage valuation risk where things are getting very frothy, or can get more frothy, where the hype tends to concentrate in the later stage. We invest with AI native specialist managers. So we back fund, VCs who really live and breathe this technology. The GPs have often done that their entire careers. We will not back generalist firms or others who are just chasing this trend. So because we believe that expertise is how you cut through all of that noise to find the real signal. And we also diversify across the full stack. So the exposure that we have spans the full AI tech stack, which I'll show in a moment, the infrastructure layer, this picks and shovels layer, the model layer themselves, and all the middleware and the app layer. So why that's important is because it helps buffer against any one layer being, particularly noisy or overheating at any given moment. And we invest through volatility. So we don't try to time it or time the sentiment. We stay active through these cycles. We have our conviction, and yeah, we believe that's where the long-term value is really, really often created. And then we selectively follow on into conviction, meaning we're watching this early stage diversified portfolio of companies. When we see one that's very promising, that could emerge as a long-term winner, that's where we choose to double down and have direct investments that we often offer as SPVs to our investors. So we're selectively increasing our exposure in the later stage rather than spreading capital around too thinly there because of what I mentioned about the later stage valuation risk. So we're very structured and rigorous with how we approach this, and we are very disciplined and cost aware. Our strategy is really built to compound over time. I'm not going to spend too much time on the tech stack in this webinar because we do have another webinar from a few months ago on our AI investment thesis, which talks about this in more detail, explaining the different areas, what trends we see, what we see happening, who's building in this space. We don't have time for that detail now, but it's just to show, this infrastructure layers where we talked about the heavy capital and CapEx investment into hardware, chips and compute, data centers, et cetera. A model layer on top of it, especially on the right-hand side, those foundation models are the big LLM players, big incumbents. But there's a lot more here as well. It's in the old tech world, we'd call it middleware, which is all of these solutions and platforms that you need to be able to integrate the models with the app layer that sits on top of it. So they're making it interoperable, they're customizing it for specific industry use cases, these APIs and hubs that the developers use to access one or a mix of LLMs when they're building apps on top, and so on. And then the app layer, where there has been a real boom, especially in enterprise productivity, because there's immediate go-to-market. We know the corporates are adopting across every industry and using it to transform themselves, both in terms of taking cost out, but also top-line growth. But up here in the app layer, we also have creative and individual tools, agents, agentic AI, and copilots. And these aren't necessarily MECE, there's overlap. You can have like an enterprise tool, which is also an agent. But just for simplicity, we look at it this way. Okay. So I can't specifically talk about our funds, but this page just really demonstrates that our strategy is diversification across the stack by geography and by stage, with a real focus on pre, seed, and A stages. So our investment edge, and there's just one slide left after this with the bottom line takeaways for you. So our investment edge, we're very focused in certain technology areas, and in this case, AI. We partner only with pure play VCs and managers who have long-term conviction. So again, not chasing the trend, not chasing the hype. They have been, former builders themselves in this space for decades, some of the GPs, right? They have real deep technical expertise. It's not just an add-on. We are an institutional platform. with an established framework. We have 5 prior fund to funds, all with strong performance. We're now leveraging that in the world of AI. We have long-standing relationships because of our, the work we've done across exponential tech areas in general. We have a lot of very strong relationships in this space that we leverage, and we provide that access back to our investors. These tech areas can be kind of an inner circle world, and we do have long-standing relationships with top thinkers and builders, and that's how we find the best opportunities. That also gives us access to information, early signals, insights, which we share back with all of you through webinars like these. Our team has a lot of experience across the tech itself. In my case, AI, are managing, in the venture capital world, in institutional investing. And the timing, we are at this major inflection point. And we believe that that's really exciting, that this is a rare window where if you move early and you do it in a way that's strategic and disciplined and thoughtful, you can really access asymmetric returns, capture the vast amount of value that's yet to be generated here. And that there's a lot of clarity in the cool down, and that's not a phase we shy away from. The hype recedes, capital tightens, gets more selective, and this is where the future winners really emerge. So, bottom line, to answer the question of this webinar, which is AI a bubble? We would say, in some ways, yes, the enthusiasm and noise are currently very high. Some valuations will fall. They'll correct back down. Some companies will absolutely fail those experimental early use cases. However, the technology is still very real. The potential, the promise, the way that it will underpin everything we do in the future is very real. We are still very early in this cycle, and that's a reason for a lot of the uncertainty. We don't know what we don't know. But we feel the bigger risk would be missing exposure completely and turning away from this, or leaning out as an investor at a time where you should really be leaning in. But leaning in a way that's disciplined, that's patient, and that's selective. And that's why we really believe in our strategy, which is built to do exactly that, and not to chase hype, but to stay really diversified and invested and lent in through this cycle that we're in. Thank you. That concludes the main webinar. I'll have a look in a moment whether we got any Q&A through the chat, but for those listening here or later through our channels, if you have any further questions, you can always reach out to ir@fifthera.com, and our team there will triage you to the best person to answer any questions you might have, or you can also visit our website. Thank you very much.